Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. I want to touch back on the thesis, and again, what I do on the thesis of the channel is I've got a lot of new subscribers. I keep refining the thesis over time, and I created this for another channel that I spoke with. They'll probably be releasing it as well, but I want to go through it on our channel so everyone sees it on our channel as well. This is the thesis that I came up with. I did not read this from a book. It is self-made by me. And I went through, as an investor, trading in and out in my early years. My time frame was all messed up. And I did some thinking on how to become a better investor. And I came up with this, what's behind me. And I'll go through it so you guys can see kind of what I'm talking about. And this isn't the entirety of everything, but it's a good chunk of it. So I'm gonna walk you through the thesis that I came up with. You guys can put in the comments section, shoot holes through it, and that's fine. I'll continue to refine it, but this is what it is. So I'm gonna dive in here. I'm gonna go through the thesis with the latest updates of everything. So what I have in the upper left-hand corner here is new privately owned housing unit starts. What that is just residential single-family homes. And what we can see through the housing starts is the real estate cycle. There's 4 parts to a real estate cycle. There's a recession where it goes down. There's a recovery phase where it goes up, but it's under the average. And the green line's the average line of the homes that are being built per year. It's about 1.4 to 1.5 million. That's the average. When you go above the average and you're increasing, you're in an expansionary phase. So this just cycles back and forth. Recession, recovery, expansion, hypersupply phase, recession. Recovery, expansion, and so on. And that just cycles back and forth over time. That's the real estate cycle. The real estate cycle is driven by demographics. And the real estate cycle, in my opinion, and demographics, sets the pricing of assets through interest rates. And I'm going to describe how that happens. But I wanted to show you a couple of big expansionary phases. The expansion phases are colored in green. The recession, or we'll call it phases where the real estate starts went below the average, is in the red. And there's a couple of things that you can glean from this chart quite quickly. We had very large expansionary phases in 1970 to 74, and another large one from 76-ish to 1980. This was the baby boomers coming through home buying years. And we had a very large expansionary phase. In that phase, it was very inflationary. And an alignment happened also in that phase. The alignment is the commodity to stock ratio through a buy signal for commodities at the beginning of that expansionary phase. That's what these circles are, the top and then the bottom. We also had an alignment in the valuations in 1998, where the commodity to stock ratio threw another buy signal at the beginning of an expansionary phase of real estate, and then it ended when it went negative, or a deflationary front. Now, there's a couple of other things I want to talk about here. This last bull market in real estate went far high. We built a bunch of homes, we filled the inventory levels back up, and then we had a bunch of bad loans, which put a bunch of foreclosures onto the market. So we built too many homes, which filled all the inventory, and then on top of it, we had foreclosures that came back online and really filled the inventory up. That's why we have this massive red area under the average here, and above the curve is this area here, which screwed up the housing market because the housing starts went down to levels that were not seen in the past 50 years. We built far too few homes for too long. And if you notice, we're coming back into an expansionary phase of real estate just recently. And at the beginning of this phase, we are underbuilt by 5.5 million homes. So we have to build a lot of homes. And the demographic of the baby boomers that came into home buying years was this demographic here. We had Gen X, which is a smaller demographic, was through here. And now we've got a larger demographic, and I'll show you below what that looks like, coming up into home buying years for the millennials, with a 5.5 million home shortfall of this big shortfall before it. These circles here that I have circled on this chart, that's these circles. And this is the commodity index to S&P 500 ratio. And what you want to glean from this chart here is that when it's low, commodities is cheap. So commodities cheap, and commodities cheap. Commodities are expensive at the top. We want to ride it from a cheap to expensive ride like this. We want to ride that up. And all this is is identifying what's the cheap asset at that time. So commodities. And you would want to, looking at the housing starts, buy it here, sell it there, buy it here, sell it there, and buy it here. You want to buy it when it's going into an expansionary phase, and you want to sell it when it's going below it. Even though this one had demographics that supported even more, you would have been better holding through this entire area. But this is the ride here. You sell it there, and then we've got hopefully a nice big ride coming up in front of us. Another thing I want to touch on. My theory is new homes coming into existence here, the expansionary phase. Why do I think that is inflationary? So what happens in a fractional reserve banking system? The money goes into the banks, the commercial banking system. That money has to get loaned into existence. The expansionary phase of real estate is that loaning credit expansion. New homes being built get new loans against them. And there are brand new loans. They are 100% inflationary. You're not replacing a loan on an existing home. You have a new loan that's brand new. So when the expansion phase goes way up, you have an increase in the money supply. And what I have below here is the money supply underneath this housing start. So if you the M2 money supply is in the black, and just look at how this thing cycles up and down. We had a low point here, which is where we went negative, and then we started cycling up, an increase in money supply. We cycled down to the bottom, cycle back up. That's this guy here. And this chart is more or less this guy dragged down over it. So what I'm saying, by looking at how this moves, this guy is this guy, this one is this one, and it's the same chart. This chart overlaid on this is just the housing starts. And the greater this thing goes up, the greater the inflation rate we get, for the most part. Now, inflation is the red line. M2 is the black line. This is the M2 money supply. Eventually, that money works through the system and we get inflation. It's delayed by about 1 or 2 years, or maybe even 3 years, depending on how it works its way through it. After 2000, the dot-com crash, which is right here, after that, they started printing a bunch of money and doing QE and messing with things. The M2 money supply gets a little bit jacked up. It still follows it. You can still see the crashes and whatnot. But there's other money thrown in this M2 money supply. One thing I want to make sure here is this is delayed. And if you look at this supply here, the M2 money supply goes up and the inflation goes up. I don't know what this is going to bring us, this large increase in money creation. I think we're going to ramp higher in our inflation rate, that just by looking at the M2 money supply. But I'm curious to see how this all works out. Another thing I want to make pretty clear, when the real estate housing starts decline, we get recessions. That's the dark gray lines in this chart. If you notice, every time the housing starts decline, we have a recession. One here, There's one we missed, one there, recession. There's one there, that's recession. We decline there, recession, decline, recession. Every time it declines, we get a recession when it's declining and goes below the average. Recession. What is a recession? A recession is a contraction in the money supply for the most part. It's a deleveraging outcome. Deleveraging means that your money supply is declining. It's going from a high inflation rate to a lower inflation rate. And it's the M2 money supply that's getting destroyed. So we are going into an expansionary phase of real estate going upward, sideways to upward. If I were to guess if we were going to have a crash, that we would have to see this decline first. And right now, with 5.5 million homes that are short in deficit, I don't think that we're going to have a market crash because of that. We're too short in the home builds, and the leveraging and deleveraging happens in real estate, which essentially affects the prices of all assets. And why do I say that? So this inflation rate, as it goes up, like in here, interest rates are typically low at the bottom of a recession in real estate. They go down. Lending, the demand for lending goes way down. When demand for lending goes up and we get inflation, it puts bonds in a bad situation. The inflation means that you're losing purchasing power on your bonds, and if interest rates start to go up, you're losing face value on your bonds. The price of them, the current value of them, is going down in an increasing interest rate environment. Now, if you're in an environment where inflation is going up, that's the red line, these red lines, that's going up, and your interest rates start to go up, people will sell their bonds and rotate their money into inflation-protected assets. That would be gold. Gold and commodities. And in the 1970s, when we had these high inflation rates and the expansion phase of real estate, we had an energy crisis. That was when we hit peak oil in the 1970s for the United States. There was an energy crisis. So with oil being expensive and energy being expensive, it filtered its way through into all of the product costs. Does that sound like a situation that's familiar today? We've got 2020, we're going into an expansion phase of real estate with 5.5 million homes short. We've got a whole bunch of M2 money supply increase. And we have an energy crisis that's upon us. Sounds very similar to the 1970s, with extra juice added in there with that money supply growth. Now, we're coming here with the commodity index to S&P 500. It is cheap. I zoomed in on this right-hand side and created a real-time chart. So here's the CRB to S&P 500. And we know technical analysis on this channel, and we're going to use it to the fullest extent. We have a line coming down through here, and it broke the downtrend line, the big downtrend. Step one in creating a new uptrend is to break the downtrend line. Step one is broken. We pulled back to do a retest. That is a higher low. Here's the low, higher low. We came up, we broke this pattern here. And we broke to the upside, creating a higher high. A higher high means that you are now in a new uptrend. You draw this line across, we're back testing it right now, and we're probably going to head higher again. What I see here in the CRB index to S&P 500 is a new uptrend. We broke the downtrend and we have created a new uptrend. And remember, these things take time. These are in years. This isn't something that you make money fast, even though you can make money fast, and it could be copious amounts. The trend is up. We are in an uptrend, and it just broke the downtrend line and starting to head higher. So we are coming from very low valuations for commodities, and the runway in front of us in terms of value is absolutely wonderful because we can go far higher and eat up that huge runway value there. So we've got the CRB index outperforming the stocks, and it's moving on up right in front of us. What I have here is the demographics. The demographics, and what's important in demographics isn't just the demographics and saying that the age is coming back down. It's home buying years that we are interested in. and we're looking for first-time home buyers. And the median age for first-time home buyers is about 33, 34 years old. That's right where we are at this line right here in 2020. As time progresses, we are coming through the largest age cohort in the millennials, where we're going to drastically increase the home buyers over the next 5-6 years. And we've got low inventory and a 5.5 million home deficit. What do you think that's going to do to home prices? It's going to go way up, Mr. Finding Value. Exactly right. So I think with this demographic coming into home buying years, which is much larger, I think we're going to put a lot of strain on the housing market, and prices will most likely go up as we work our way through this largest cohort. Afterwards, yes, it's going to be a little bit rough. We're not going to have to build as many homes, and it will depend on how many homes we build. But in front of us, the next 5, 6, 7, 8, 9 years, however long it takes to build all this, we have a problem. And it's going to be, my guess, inflationary. Now, under the conditions that I'm talking about, under a demographic that's coming up, under a home shortage in America of 5.5 million homes, we should see an inflationary period. And if interest rates go up, it's going to have an impact on bonds and stocks, and that money should rotate over into gold and precious metals. This is the gold to monetary base ratio. Last time we had the same market conditions, gold revalued itself all the way up. It did a 25x from 1970 to 1980. It went up 25 times in value. And if you look, 1970 to 1973, 4, and then we had that crash in there. That's this crash coming down right here from 74 to 75. That is this dip in the M2 money supply. That is this dip in gold. And then we rocketed higher because we went back into an expansionary phase where it was very inflationary. And it peaked at 1980 right here of the red line. Remember, these are offset by a year or two, the M2 money supply and inflation. So when I look at this gold to monetary base ratio, we are incredibly low. That's number one. We're super low. We've never been this low. And in the environment, the conditions that are coming up in front of us, this could revalue all the way back to a much higher level. What level it's going to revalue to, I don't know. But I can tell you that the gold to monetary base ratio, that gold has not accounted for the money that's been created in the monetary base. And if or when this comes back up, you're going to see a large revaluation occur in gold, and it's got a huge valuation runway. So when I look at these investments, when I look at them, what I look for are the conditions that these investments occur in. We can look at all these charts, and all these charts are going to tell us things. We can do all the technical analysis in the world. And what is technical analysis? Technical analysis is herd mentality. It's how humans interact with each other. Now, what I'm trying to do is trying to get to the root cause. What is causing the herd to shift money around? What is causing it? And that is what I set out to answer with my thesis. That's what's behind me. So what I'm trying to do is I'm trying to pair up a couple of things here. I'm trying to pair up what causes the herd to move money, and where does that money go under certain market conditions. So what I did here, and just showed you some charts and graphs and whatnot, is that we have a real estate boom that's right in front of us. It's happening. It's an expansionary phase of real estate. Check. That means it's going to be an inflationary environment. We can see that in the M2 money supply and the inflation that's lagged behind it. So that's a big check. Then we see that the valuations of commodities are incredibly cheap in relationship to stocks. Check. It's great for commodities. We can see in the charts that that's starting to turn and that commodities are starting to outperform stocks. Check. It's in progress. The expansion phase is not only valid, but we're validating that thesis. We're validating that chart and the demographics and everything with other data. We've got the gold to monetary base, huge valuation runway in front of us. Check. Now, what else do I have? So I also looked at some of these other charts. And what I have here is the gold to oil ratio. The gold to oil ratio is, we had this huge problem. And I said, like the 70s, that we had an energy crisis. We had a peak oil in America. The gold to oil ratio shot up over 100 if you plotted it real time, but let's just say 90 on average. And investment got cut back drastically. Also, from the ESG movement, we're cutting back investment into oil. And what we're seeing in natural gas, then it spread to coal, and now it's spreading to oil. And it will eventually spread to uranium and everywhere else, anything that's energy related and has high energy returns, is that we have an energy crisis, just like the 1970s. And with that underinvestment, we could see far higher oil prices. On the right-hand side, what I did is I took crude oil and I charted it out. We broke to the upside here recently. If you were to take this projected move, throw it on top, it says that oil could potentially go 160 plus is what I'm getting for a projected move on oil. I don't know the time frame. Could be a couple years. Not exactly sure. I don't want to get too caught up in time frame games. We broke the pattern, and it's moving to the upside. That's what's important. Looking at the lower left is gold on a big picture view. It's just a big flag pattern. It may take some time to break out of it, but it's massive. We can see a very large move up in gold eventually. And then I've got the gold and silver index versus the gold ratio. Historically, it's around 0.25. We broke to the downside here. We consolidated for a little bit, and we're trying to make a higher high. This would be a new uptrend if it breaks this line right here. We're very close. I think we're doing it right now. And gold and silver mining companies are probably a good spot to be, in my opinion, and I have money in them. And I do favor the royalty companies because of input costs. But overall, that chart looks absolutely incredible. So we have an energy crisis ahead of us. We've seen this ratio compressing down, which means oil is outperforming gold and could potentially go where this star is. So I think oil is going to outperform here over the next couple of years. We could see the projected move quite dramatically. We broke the downtrend line and the pattern for for oil. And then gold is also forming its own pattern, which will eventually be delayed behind oil when inflation starts working its way through the system. And we can also see that the gold-silver index to gold ratio is lining up for a massive move. Also, we also have some more here. So what I have up here in the left is platinum. Platinum is also breaking out of its pattern to the upside. We have natural gas, which is breaking out of its channel that it was in for a good 6 years, breaking to the upside, ready to go. We've got uranium on the bottom here. I've got uranium priced in dollars. It's breaking to the upside. And I've got a pound of U3O8 in gold grams. And if you chart this thing out, it's breaking to the upside as well, which means that uranium is outperforming gold. These are all things that you would see in a commodity bull market. And we're seeing it in all of the commodities breaking their large chart patterns. Let me see if we have any other charts here. We've got the copper to gold ratio, the longest downtrend ever broken. I drew the downtrend line in. Copper is breaking out in relationship to gold. That is very bullish for a commodity bull cycle. Copper usually outperforms gold, so does platinum. And we're seeing those patterns break to the upside. And then we also have gold price and 10-year treasury bonds. This is the yields over here, the yield. We've got a large revaluation from 70 to 80. From 1970, we had very high increasing interest rates during that time period. From 70 to 1980, we also had very high rates of inflation. What that does is that people in bonds run away from bonds because they're losing money in bonds, and stocks really don't go anywhere. They go sideways or a little bit lower. What that means is that money's rotating into precious metals and commodities to protect itself from inflation and rising interest rates. So the key here that you want to see is if this over here starts to break to the upside with higher yields or interest rates, I think you're going to see a large rotation of money out of bonds and stocks and into commodities and precious metals. Now, the question that everyone's going to ask is, governments are in debt. How are they going to afford it? I don't know. That's the problem, the predicament that they're in. People say a problem. Well, problem has a solution. Well, I don't know if they have a solution for this. So I call it a predicament. It's a predicament that has outcomes. You're painted into the corner. You don't know what you're going to do. And you're going, well, if we raise rates, we bankrupt the country. If we keep rates low, then your dollar goes to far lower valuations. So people become poor through the dollar. I don't know which avenue they're going to take. I don't have a solution for that. And it's not my duty to have that solution. But what I'm doing is I'm preparing for that outcome. That's all you can do. So when you look at all of the data I have right here for the thesis of the channel and tying this all together as best as I can, is a demographics coming that's a little bit larger in home buying years. It's going to be inflationary, and we've put a whole bunch of other money into the system as well. So I think it's going to be inflationary. If we have inflation that comes on up, like we're seeing, I think it's going to have an impact, or at least put a lot of pressure on interest rates to go up from people selling their bonds. If interest rates go up, the valuation of those bonds goes down, and they want to sell the bonds. Money's going to rotate out of bonds and go into inflation-protected assets, or assets that won't go down because of an increasing interest rate environment. Stocks also struggle because they've been priced to the moon with very low interest rates. When interest rates go up, their PE ratios are going to shrink. Their prices are going to come back, or they're going to go sideways for a long time as their earnings go up. But their PE ratios shrink because people aren't going to be forced into those assets because of low interest rates. People go into those because of low interest rates. So that money's going to rotate out of stocks and bonds, right at commodities and right at precious metals, because that's the best inflation hedges. 1970s, the environment in that was an energy crisis environment. Oil went through the roof. To 2021, we have an energy crisis right in front of us. Oil's going to go through the roof. And you're going to see energy go up quite a bit. And usually it goes up so long that we have an expansionary phase of real estate. That's what I've seen in the past. That's what I'm guessing is going to happen in the future. So real estate starts. We need to watch real estate starts. We need to watch real estate in terms of inventory and days on the market. That active listing counts is what interests me. So long that we have low inventory and then we have housing starts going up or staying above the average, we have that type of market conditions that are conducive for a commodity to gold or commodity and precious metal bull market. So tying that all together, and hopefully this makes sense, that's the thesis of the channel, and that's kind of what I put together. And the most compelling thing is that all of the technical analysis that I know, which is very simple technical analysis, we're breaking down trend lines, we're creating new uptrend patterns in basically everything that I monitor. So that's confirmation that this thesis is at least working. If you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.